Advanced Financial Modeling, Topic 10, Capital Budgeting, Learning Objective Number 4, Understanding Capital Budgeting Process and Valuation Principles. So let's talk about capital budgeting. Capital budgeting is an annual process that most corporations have. It's a process of selecting which CapEx investments to fund to increase firm value. So in theory, all positive NPV projects that a company should discover should be done. However, often organizations have a fixed CapEx budget. So what we want to do in this case is to choose the select the set of investments within the budget that maximize net present value. That would, in theory, increase firm value. So let's talk about some valuation principles. When you're choosing which investments, say buy this factory, get more delivery vans, open another store, buy this other firm, all these are capital expenditures. There's certain principles. Those principles are: number one, use after-tax cash flows, not accounting profits. Profits are not cash flows. Second, whenever you have them, use market values and not book values. If you're going to say dispose of a piece of equipment, you want to use what you'll actually get for it. Now, book value is important to calculate taxes, but we want to use market values when showing the change in value or the acquisition or sale of something. You want to use unlevered free cash flows, which, remember, excludes debt and interest. Now, this may not sound like it's correct. Why wouldn't you include an actual expense, say interest expense? However, I'll show you later that it's actually much easier to compute unlevered free cash flows because you don't have to forecast debt balances or interest rate changes. And also, the effects of financing will be incorporated in the discount rate, which will be in the next topic. So you put the effects of financing in the discount rate, not in the cash flows. And just a reminder, the unlevered free cash flows, FCFFs, are EBIT after tax. Add back depreciation because that's a non-cash expense needed to calculate taxes. We want to then subtract out CapEx, add any salvage of that CapEx or resale of the value of the CapEx, and subtract any changes in net working capital. And we want to make sure you do not include any sunk costs. So if you've already spent some money to do some kind of study before you would actually invest in a project, you don't put that in the net present value calculation or the free cash flow calculation because they've already been sent or spent. Also, you don't want to include any allocated costs. Many corporations have these things called overhead pools, where they might allocate some portion of prior fixed cost expenses to different projects. However, if they are not incremental expenses, you do not include it. What you do include, any opportunity cost. If you're using property or space that could be used for another part of the business or it could be sold or leased, you want to make sure you put that foregone opportunity. If you're using equipment that could be sold, you want to include that as an opportunity cost. You want to make sure you put any synergies or add-on sales. If you're going to launch this project and it's going to create, or a new product and it's going to create sales for an existing product line, you want to include that. The opposite side of that is you want to also include any cannibalized sales losses. If you're going to launch a new product and it's going to steal sales from an existing product line, you want to make sure you subtract those lost sales. You want to make sure you include any incremental working capital needs, the changes in receivables, payables, inventory, cash needed for operations, and that's going to be in that net working capital. And also you want to make sure you fully incorporate taxes and tax shields. So you want to make sure it's after-tax cash flows, and if there's any tax shields created from purchases, you want to include that. So that's it. Those are the principles for capital budgeting and the evaluation of investment projects.